Welcome everyone. Kevin and I are back with another episode of Back and Forth with Becker and Orr. Lots of great topics today. You can see all of them at the bottom of the screen. The lead-off topic there, are we due for a market correction? They're at record levels. Are we due for a correction? We're going to get into that.
Yeah, we got a variety of things to talk about today. It's going to be a big show that we have. Now, remember, you can find this and any of our other back and forths or financial 15s on our website at beckerorr.com, or you can go to our YouTube channel to find it out, or like us on Facebook and see what goes on from there. Okay, we're starting off today. Correction. Are we having one?
Oh, we're not having one just yet, but we could. It could. Let's look at a little bit of data. I'll pull up the chart here. We have to give credit to JP Morgan and also for the Canaccord team for putting this together. But we're looking at the Canadian stock market here, the S&P TSX, going back to 1980. And then the gray bars there are the performance of the TSX in a given year. But all the little red dots is the intraday drop. Now, 90% of the time, at some point in the year, the Canadian stock market pulls back 5% or greater, and it's a rarity that you get through a year without at least a 5% correction. If you look at the current dot, you can see year-to-date Canadian market is certainly in positive territory, and that little red dot there, Kevin, is only at 4%. So right now we're in the minority, having not seen a 5% correction. So are we due? Are we due for a market correction?
Well, yeah. I mean, that's definitely a question to take a look at. Now, each time I think we've had one of these, there's been some sort of unprecedented scenario for why that's happened. And right now we're going through the same thing. I mean, all of a sudden you've got reopening coming. You've got tons of monetary stimulus. You got tons of fiscal stimulus. So everybody's got that euphoria right now that, hey, the only place to go is into the market. I'm not making anything at 1%, so I might as well let it run. And so you're not getting those big corrections. And even when you do get something, it's fairly insignificant, 1.5% maybe in the day, and a few days later it reverses itself. So yeah, I agree that we probably do have some form of a correction coming. Whether or not we're going to get that 5%, it's hard to say at this point. It depends on whether or not more stimulus comes, whether there's a fourth wave and things along those lines. But yeah, you're right. I mean, it is definitely an anomaly to see this. We would expect it. And I think a lot of people would be waiting for that. Wow, 5-8% pullback, I can buy in. But, waiting for that time frame, we've always said market timing is hard to do.
Yeah, this has been very true market time. Someone waiting for a pullback's been waiting for about 18 months now. It just keeps going up. We haven't really seen any major pullback in that time period. Important to note, even if you do get a pullback, 7 out of 10 times the Canadian stock market still finishes in positive territory. So if you get a correction, it's not necessarily a bad thing. Doesn't mean the bull market's over. In fact, I think we'll probably see a bull market for a few more years, but we'll likely do. Just given the data, it'd be an anomaly if we finish this year without a correction of at least over 5%. Not the end of the world, though, if it does happen. Let's shift gears here a little bit here, Kevin. I know you're certainly a movie buff. I'm definitely a Marvel fan, so this is both up of our alleys here. And we've got Black Widow, which just came out and hit some box office records, at least some pandemic box office records.
Yeah, I mean, pandemic box office, when you make $210 million opening weekend, I mean, I don't even think that's pandemic. You should be doing that normally. I think that would have done it if you'd have just had the theaters alone. But yeah, I think we're seeing a bit of a new scenario here, as you mentioned. I mean, almost 160 million worldwide, not counting the 60 million on Disney Plus. And that's the first basically for Disney Plus. There's this one. I heard they're also doing Jungle Cruise is going to be the only other one that they're looking at the same sort of timing phrase. But this is going to prove how is it going to go going forward. I think people are coming very comfortable to be able to do that one and how that sort of plays. But yeah, I mean, we could see a few more of these going forward just based on where we are. But as we reopen, I think 158 still proves that there are people that are going to the theaters. Now, I know that you are, the same as I am, a Marvel fan, and I haven't seen this one, but I believe that you got a chance to look at this over the weekend. Did you not?
Yeah, my wife and I were part of that $60 million there. They got on Disney Plus. That's part of Jody and I's money. We certainly paid for it. It was a great movie, by the way. Fantastic. If you can wait to see it in theaters, and a quick note, only 85% of theaters were open worldwide, and certainly Canada is well below that number because we still have a lot of theaters closed. But if we're able to watch it in theaters, it certainly is a big blockbuster. But you mentioned buying it through Disney Plus. I had quite the experience because normally when you rent a movie, do something online, you hit the button and ask you to confirm you sure you want to rent or purchase this movie. You hit confirm and you're done. Not the case with Black Widow. You hit the button and it says go to this website, leave the app, go to the website, then put all your data in the website to buy or rent the movie, then you have to go back into the app to watch it. I thought, why are they making it so difficult to get my money? Normally they want to streamline the process, not add all these obstacles. And then it dawned on me, Apple, Google, if you make any purchases through an app, Kevin, they take 30%. So Disney Plus gets $60 million for all these purchases with Black Widow, while Apple or Google are going to take 30% of that right off the top. So Disney Plus does this big workaround to get people to leave the app to make the purchase elsewhere so they don't have to pay Apple or Google. And we're already in a mix of the fight here, aren't we? This isn't the first time we've seen people try to avoid these fees from Apple and Google.
No, you're right. And I mean, I'm sorry. If I'm Disney and I'm seeing all of a sudden that $20 million is going to go away to Apple just because I put a name on a little app and put it on your store, no way. I mean, you haven't done anything to earn this. But you're right. This is not the first time we've seen this. Fortnite would have been the best example seeing this going forward. I mean, I remember that they tried to do a circumvention around Google as well as Apple on their app stores to say, look, we're the ones that are making all the money here. People want to see us. Why are we paying you this big money? Why don't we just send them to our site? At which point, of course, you heard Apple and Google come out and say, well, fine, we just won't run your app anymore. Well, all of a sudden, that's been the big problem. And as you mentioned down below on this screen we've got here, they have an antitrust lawsuit going on in Australia that Apple tried to dismiss, but wasn't allowed to. So do you think that this is going to be more the norm? People are going to try to circumvent best they can?
I think so. I mean, that 30% is pretty outrageous. And there's really no competition. Like, if you're not in the Google Play Store and the Apple App Store, like, where are you going to get your app? Like, really, that's where the majority of the traffic goes. And that's really the heart of the matter in that antitrust suit between Epic Games, which is the maker of Fortnite, and Apple, is Epic Games is saying Apple does not allow other stores on their platform. So they say the only place you can have your app is in the App Store. And by the way, when you're in the App Store, we take 30% of all in-app purchases. And they're saying that's an antitrust suit. And we'll see how that plays out. But I think eventually that's going to change. Maybe you get a workaround, or maybe you get big companies that try to negotiate and say, hey, we're a large company, we got lots of traffic. You're only getting 10% of our purchase. Maybe they start to do side deals. We'll see. So far, they've been pretty strict, saying, nope, everyone's 30%. But Disney Plus is probably not alone in finding creative ways to get people to access their products, but avoid this extra fee from Apple and Google. So I think we're going to see more of that going forward.
I would believe that that's easily the biggest scenario. And especially when you get a big company like Disney, I think they have that sort of power structure to say, look, we're going to negotiate a deal. And if they do it first, then hopefully everybody else follows suit. And Apple and Google are sooner or later, I think, going to have some bending or else. But after that one, I mean, now that Disney's done, now that you've seen Black Widow, let's get back to the inflation question. Okay, back to the markets, as it were. Inflation. Is there any inflation out there? Not only that, but how is the inflation affecting sort of your fixed income investments?
And that's really the key here. So we all think there's going to be inflation. We're reopening the economy, lots of demand, but how does it impact things? And we're seeing bond yields have been dropping. So if you have higher inflation, lower bond yields, that means you're not going to keep a lot of that money after inflation. So you get your bond payment, but now you got to factor in inflation, not left a whole lot afterwards. And what we see on the screen here is a chart from Charlie Biello. It's a high yield bond in the U.S. And for the first time ever, Kevin, after inflation, the yields are actually negative. So we're in uncharted territory here when it comes to U.S. high interest debt. So first quick explainer, high yield bond, that's normally a company that's not in the best footing. It's not the World Banks of the world. These are companies that are probably in a little bit of trouble, but they pay higher interest rates on their bond to attract investors. So you're getting those higher risk, higher interest rate payments, but after factoring inflation, it's still a negative territory, a first time ever for the U.S.
Yeah, I mean, basically, I mean, it's funny when you say that. I mean, a lot of people, you hear the high yield bond scenario, and I mean, let's go back to the 80s. At the 80s, that was known as a junk bond. And that's exactly what it is, right? I mean, it was never one of these things where it didn't have the credit quality you mentioned of an RBC, or you're getting something along those lines. So to actually have real returns negative is something that's incredibly significant, just because, you know what, you took your chance just so you can get a better yield so that you're making some money at the end of the day. After we take away the inflation, real returns right now are there. Now, a possibility on this I could see is that there's so much comfort in there because of what we mentioned earlier with the correction, monetary stimulus, fiscal stimulus, market reopening. Everybody feels that things are going to go forward. Eventually, I think some of this has to correct itself somewhere. I mean, either we're going to find out that the inflation we're hitting at right now is either transitory, but if it does become real, then you probably get spreads or something along that line. But you're right. I mean, it's a historic moment to see when you actually get a negative high yield bond real return scenario.
And it's a key point there on the risk. Like, risk is always a matter of perspective, and it's not set in time. It's not as if the risk is static. So it could be the fact that people are feeling more comfortable, so they don't think these bonds are as risky. which means the yields come down. And then we have higher inflation right now as we reopen. So it's a combination of factors that hit there. I don't think this is going to be a permanent feature for high yield bonds. I think it's more just a moment in time, a historic moment at that. But let's move along to the question of the week here. We always love questions from clients and from everyone else. And we got one I received. I get it. We're reopening. People are thinking travel. They want to explore. Normally when you travel, you do so in US dollars. So the question is, should I be buying US dollars now? What's your take, Kevin?
Well, I think it becomes one of those things again where, you've got to consider all your circumstances. Am I dealing with a small amount of money I'm looking at, or am I dealing with, trying to accumulate 10 or 20,000 in US currency? Mm-hmm. I mean, the rate right now is over 80. Is it going to go to 85? Is it going to go to 90? Definitely a possibility. But could it pull back to 75? That's also in the realm of possibilities. I mean, it depends. So many factors in there. Will we continue this reopening? Will we need more energy and materials, which of course is good for the Canadian dollar going forward? Or will we start to see a fourth wave or things along that line? Again, depending on the size of the amount, averaging in is never a bad thing. Or if it's smaller, again, you've mentioned before fees and things like that. So my view is, if you have that opportunity, depending on if you're going for travel or something, maybe you buy now. If you have time to wait, you can see where things go. What do you think? Is there any formula for this?
Yeah, well, there's no magic solution. Of course, if we knew exactly where the dollar would go and could predict the future, we'd just buy when it's at a peak. But we don't know that peak until after the fact. I think you're kind of one or two camps. If it's a larger dollar figure, well, then break it up. Do a couple of little pieces. You won't get a perfect price, but you get to average the price out. So that way you're not going to get the worst scenario. You might not get the best, but you get a nice average. So if you have, say, 30,000, well, maybe do a couple of chunks, and then you get your eventual US dollar amount. And then the other option is if you have a smaller amount, I really wouldn't worry too much about it, because if you break it up into little tiny pieces, the smaller dollar figure you try to convert, the larger the spread and the transaction costs. You can actually incur more fees if you try to do all these little transactions just to avoid the dollar. So you could be going from the frying pan into the fire. So you have to keep that in mind. So it's not a one-size-fits-all there. Larger dollar figure break up, smaller dollar figure, perhaps do it as a lump and don't worry too much about the overall rate. Any final comments there, Kevin? Anything you want to add?
Yeah. No, as you mentioned it, we've always said that market timing is hard. You don't try to time the market, it's time in the market. Same sort of thing can go on with exchange rates. You don't want to time whether you get the high, just, if it looks good, we go from there. Other than that, there's nothing else I want to say. Remember, we will answer your questions, whatever you've got, whether it's financial, any of the things we've talked on and back and forth. Please visit us or chat with us at Chat with Clinton and Kevin on the website. We'd be happy to answer the questions. Otherwise, I think, we've covered a broad range of topics right now, and we have to see where we want to go from this next. That's about all I have to say.
Well, end on that note. Everyone take care and stay safe.